Okay, that's great. I was just saying that thanks to you, Dr. Vivek, for having me here, and thanks to everyone. Afternoon, it's already afternoon right now. Shall I say for coming? Just very quick. I guess everybody can see my screen, okay, isn't it? Just a quick check.
That's fine.
Yeah, okay, good. Let me just get this technical side correct. And okay, I think that should do it. Okay, good. So today's session is about diversifying your portfolio and mastering the whole game of money management and your money, basically. Right. So firstly, just disclaimer that, recommending anything and we don't take liability for that. That is me over there. That's me, Thiru Nagapan, founder of Master of the Markets, Illiteracy Conference, and the Traders Open Day. Just a little bit background about myself. Some of you have seen my intro video, and as Dr. Vivek said, my actually journey actually started off as a pharmacologist, a pharmacology researcher. I did my degree in Scotland. I was born in Singapore. I moved to the UK then to do my degree, 4 years in Glasgow University. Then I moved to London to do my cardiovascular pharmacology PhD. Then through an interesting turn of events, I kind of lost passion in that. And there was quite a lot of I decided to move on into the financial world. But before I actually did that, interesting thing is, I was a bit unclear on what I wanted to do. I went to this Make It Happen workshop. It got me really clear on my vision. And then after that, before I knew it, and I was on the trading floor, I met my business partner, and then we left that. We set up our own trading company. We worked on a private trading floor for about 1.5 years. We actually traded the money over there. We taught over 10,000 people over there. We would catch the markets live in front of people. After about 1.5 years, we left that, set up our own company, master the markets, and the money management company as Vedanta Trading. Right. We're also the proud founders of Illiteracy Conference, where we invited Mark Brown, institutional quant trader. We also are the proud founders of Traders Open Day as well. And also, we also present quite frequently in Round the Clock Trader Live and Break the Time and Money Link events as well. Our mission is really to spread the truth of trading to help you live a better lifestyle. I'll go through what trading actually means and everything later on. Our main unique points, there's a lot of people in the market. Our main unique points is that we are purely price action traders. Most of the price action kind of trading that we do, most would not know because of the kind of extent of time and mentorship that we've had with institutional traders. Also, all our systems are research backed and everything we do is purely transparent. This is why we've got a very good, strong following, faithful following. Our three-part philosophy is very simple. We research, then we trade it, and whatever works, we share, just like in this platform over here today. Right. I don't want to talk too much about us for today. You can find out all about us at masterthemarkets.net and at your own time. I just want to give you lots of tons of value for today. So today's session, we will look at first, the three-part model framework for profitable returns. We'll look at also the asset allocation portfolio that was recommended by one of the biggest hedge fund managers in the world. And finally, we'll look at how you can overcome your biggest challenge in this game of money. Okay, right. The framework that I'm going to share with you is not only for trading. I mean, that's not what this is about. It's for trading and it's also for investments as well. All right. Okay. Now, just a guess. I mean, does anyone know what this three-part model framework is? Any guesses? It's going to be very interactive, so feel free because that's the only way that we can really learn and then grow as well and make the best use of the time that you're spending with me today. So anyone wants to have a go, just put into the chat box. I will take a look at it later of whether you know what this three-part model framework is. Okay, so from
New
our
only.
understanding and our basis, there's a three-part model framework that is necessary for you to win in this game of money and money management. Okay, the first thing we would say is knowledge. It's just what you're here for. Without knowledge, of course, you won't have the confidence, you won't know how to also manage your money. That's the first part. You must gain the knowledge. The second part, of course, if you sit with the knowledge and do not do anything, what's the point of it, right? So, the second part of this three part model framework is after knowledge is to apply it. Okay, applying the knowledge on the ground. So no point just sitting down with the knowledge, especially in the markets, and not applying it, because then it won't translate to monetary amount. After knowledge and application is the sustainability of this two-part process. The sustainability of this two-part process, because as you know, doctors, I believe all of you here, doctors, you see, as you see, doctors and traders and investors, is that in this game of financial trading and financial investment, you know that all your investments and your trades would not go well. Sometimes you have to take some losses or you have to sustain drawdowns. So, because of this knowledge and application which carries on, your psychology will get affected at some point of time. And that will affect you in taking future investments. In fact, that's the 80-20 rule that says that only actually 20% of your trades or your investments will make 80% of your profits. So you can see how important the application of psychology is to sustain this two-part process. And that's why the last part of this three-part model framework is the psychology part, the knowledge, the application, and the psychology. Now, some of you might be asking, okay, right, okay, this is all good, Thiru. I can really agree with this, but what should I get knowledge on? Okay, especially in this game of money. There's only two main categories that you need to get your knowledge on in terms of this game of money. One is trading, okay, which is for cash flow. Most of the trading that we teach is end of day trading. I'm not sure if many of you are familiar with that. It's not the conventional trading that we usually talk about, where you're sitting in front of the screens, where, that's the conventional thing that is publicized out there, isn't it? I mean, where you got all your bank traders in front of the screen and they're trading away. That's not the trading that we do. It's more end of day. So you only analyze it at the end of the day. We've done the research, and then we see what opportunities there are, and you place it, and you just do your full-time work, whatever job or profession you may have, or business owner, in the day, and you only come and check it in the evening only, and then you manage your risk in such a way. Okay, so that's the type of trading that we mainly do. It's a bit more passive and relaxed. That's trading. Okay, the knowledge of trading must be there. Another knowledge that you need to have is investments. That's more for wealth. All right. So one, trading, the knowledge. So you see the three-part model framework: knowledge, application, and psychology. So the knowledge, what kind of knowledge we have in? We should have it in these two main classes, which is trading and investment. Trading is more for cash flow. Investments is more for wealth. Finally, what kind of instruments should we gain and expand our knowledge in for both trading and investments? These are the different asset classes. One is stocks, bonds, real estate, index and mutual funds, commodities, gold, silver, etc., and also crypto. We will take a look later on as we go on to the charts. We will take a look at some of them later on. Okay. Right. Now, here's the important thing. In fact, in my initial conversation actually with Dr. Vivek and actually Anup, is that I asked them this thing. You see, most of you here, I believe that would have invested or traded in some kind or some whatsoever. And I know my friends who own big businesses, big marketing agencies and law firms and all of that. But you see, unfortunately, when it comes to this area of investment or trading, before they put the trade or the investment, there are three questions to ask. Unfortunately, only people think of one. do you guys think are the three questions you should be asking before you take up a trade or an investment? What do you guys think?
Why?
And then from there I can just gauge the knowledge level in this group, and then we can tailor the presentation accordingly as we go about. If I were to put this as a direct example, see, for example, I mean, there's a lot of talk about Bitcoin and all of that, right? If you were to think of buying or selling your Bitcoin, I mean, mainly buying, I mean, most of you, when you invest, you will usually buy it. What is the main questions you will ask before you buy? What would it be? Just type it into the chat box. What are the main questions you will ask? Most of the time I've seen only people only ask only one question before they buy. So I can see there's some answers coming about. So let's take a look at the answers over here. So you can see, okay. Some of you are getting some of the answers. As I mentioned, there are very few people who will get all three questions because most of the time we do not think of these three questions. So let me put this into clarity. Okay, right. Some of you have mentioned, you would think about risk, you would think about, profit. Absolutely right. I can see that been well read on this. Okay, that's good. But let's take a look at more in detail. Okay, right. The three questions. The first question you should always ask. I mean, this is the one that everyone will do. The first one is what everyone will do, even without knowing that they're doing it. Especially if they see a good investment. Let's say, there's been a lot of talk on Tesla before as well, Facebook when it came to IPO as well. And then after that, all the new tech stocks that are booming, especially because of this COVID-19 perspective, Bitcoin, gold, silver. Usually, when there's an investment um, choice out there, the first thing that people come to mind, even without thinking, is just entry price. That's it. Entry. Some people won't even ask what price I should enter on. If they just hear their friends saying or the media saying, "Oh, it's a good bet," they would just go and buy it, and they don't care whether it's at $200 or $10,000, like in Bitcoin, or 40,000 at the moment. In fact, you know, um, one of my friends as well, who's an IT consultant. I mean, he recently messaged me about 2 weeks ago, and he just asked me, "Oh, he missed the boat on Bitcoin." In fact, the funny thing is, actually, he bought it at 7,000, but then he couldn't hold it, and he sold it at about 8,000. He only made about $1,000 in terms of profit, depending on how much Bitcoin he bought. But then look at Bitcoin today; it's about 40,000. It's about 37, $38,000 at the moment. And then he was just asking me just recently, "Oh, should I get onto it again at 40,000?" You see, that's the thing. People just think about only entry. However, that's not the only thing. The second thing you should be thinking about before you hit the buy button to buy any investment choice or any sell any or short the market in terms of trading, the first thing you should always ask for is, where should I enter at? The second thing you should ask for is, before you hit the buy button, is how are you going to manage the trade, which is what we call trade management. Okay, trade management, right? What do we mean by this? I'll go into some chart examples very shortly, and then we'll take a look at it together. You must consider all of this before you get into the trade. The final thing that you should be asking yourself is, where should I exit? Where is your profit objective? All of this you must consider before you enter the particular trade or investment. Okay, so based on this, okay, let's go through some examples here. Okay, so let's take a look at a Bitcoin or gold or the Dow Jones. All right, so let's take a look at that, and then we will take it from there. Let me see. Okay, so let me bring up the charts. I'll stop the share for a moment, and then we will see. Let me share my screen once more. Okay, great. So here we go. So we've got, let me just bring up Bitcoin. Okay, so my question to you guys is this, right? Let's just go back and then we can go back to the front as well to where we are at. Let's see this. So let's put a blue line over here and then we can take it from there. So let me just see. Okay. Right. So let me just make up that drawing there. Let me just put the blue line. Okay, here. Let's say we bought around this price over here. Okay, 9,960. Okay. Today, the price is at, let's go all the way to today. It's at 37,000. It's at 37,000. Now you tell me, everyone over here, right? So we can see the interaction and see all the answers that people are giving. If you bought it at 10,000, right? And currently right now, let's say it's at 37,000. So you're at about profit of about 27,000, isn't it? If you bought one Bitcoin, that is, yeah. If you bought 110, then it's proportionate and everything and so on and so forth. Let's say we are at $27,000 profit over a span of about 1 year. Okay. Now, tell me then, in terms of what we just talked about, if let's say you've not done your 3-question analysis before you got in, today, what would you do with this? Would you hold on? This is your second part, right? Your trade management. Would you hold on to it? And how long would you hold on to it? Or would some of you sell all of it? Or how many of you would sell part of it? And how many of you would hold already over here when it got to 42,000 and it dropped all the way to 30,000? So what would you all do? Just type into the chat box as of today. You bought at 10,000, you're in about $27,000 of profit. What would you all do? What is your plan? And remember, these principles over here that we're talking about will occur in any kind of trade or investment. So you must, and in the trading and the investment world, in the recent interview that I did with Steve Ward on psychology and trading, we call this what if scenarios all throughout. What if this happens? What am I going to do? What if that happens? What am I going to do? And even in business principles, whatever business you have, it is called the anticipation um, factor. Good entrepreneurs always anticipate before it happens and they prepare for it even before it happens. Okay. If it happens or not is a different question, but we're already prepared. So let's see what people will do. Right. Um, let's see. So you see you see that's this what I'm saying, right? Everybody will have a different answer. Some people are saying I won't sell if I don't need the money. Somebody is saying I will sell all of it. Some people say recoup your investment. Some are saying sell half of the shares. Some are saying sell 70% now. You see, there's too many different answers. Okay, it depends on individual choice. Okay, now let's right. So there's many different ways that everybody has proposed, isn't it? Now let me ask the people who have said withdraw your investment or sell all. Okay, sell all. Now let me ask those questions to those people who say sell all, right? Imagine now, after you've sold everything, now this shoots up to $100,000 in the next 1 year. How would you feel? That's my first question. For the people who said they wouldn't sell anything at all, they would hold on to it. Now, for those of you who said you'll hold on to it for the long run and not sell anything at all, now let me ask you, how would you all feel for those people who hold on to everything, not sell even one single point of this Bitcoin? How would you feel if now this drops all the way to $8,000? How would you feel? Because you know that this has happened before, isn't it not? When it has dropped all the way to 3,000. There you go, right? This one has happened. So let me just move my thing away over there. You see, look, it dropped all the way to 3,000. You could have bought here 9,000 and it dropped all the way to 3,000. Okay. So tell me then, for those of you who say you will hold on to everything, would you be fine? Would you be okay if it drops all the way now to 8,000? And how long are you willing to hold on to this investment? Because remember, holding on to investments is one thing. But then when you hold on to investment, professional traders and investors always ask ourselves, hey, hang on a minute. Am I really holding on to this for too long? Could my money work better elsewhere? Imagine if you have a worker and the worker is, for the money that you're paying him, he's not returning your investment for 5 years, let's say. Would you keep that worker or would you sack that worker? We have to start thinking like that. So these what if scenarios are very important. So would you sell all but still be okay if it goes to 100,000? Or would you not sell all but would you be okay if it drops to 8,000? But you bought a 10,000 and you've given away all this unrealized profit. Remember, this money is not yours until you realize it. So let's take a look at all the answers of what people are saying. Don't go by emotion fully. I'll take my capital away and let few. Yes, but feel bad in both scenarios, although should not feel, but emotions come in. Of course, emotions will always come in. So my point here is very simple. It goes back to that three-part question that you always got to ask before you enter. Is your entry, your trade management, and your exit point. It's got to be well researched and given very good reasons for why you should hold on. And remember one thing, that eventually nobody gets it all right. But what you need to think, very importantly, which most traders and investors don't think of, and your mind even won't be trained towards that, is the cumulative net result. This thing, even though we may agree all in theory, is very hard to be first repeated, practiced, and trained such that it becomes a habitual pattern. Remember, I told you a three-part model framework: knowledge, application, and finally the psychology to sustain it. You must think cumulative. It's not just about this one investment. It's about how about all the 5, 10 other investments that you're going to do. Cumulatively, are you making money? And have you done your best on it? In fact, Sir John Templeton, one of the biggest, richest, wealthiest investors of our history and of time, has said that when Tony Robbins interviewed him and asked him, what is your one main reason for so much accumulation of wealth and success? What would you say it is? And he just said it in one word. It's gratitude. Gratitude. Be grateful for whatever that your plan has given you and the money that is given you. And even if it shoots up after that, it's fine. You've done your best. Look for other opportunities. You've got your research, you did a well plan, and you thought cumulative. And it's then the cumulative set of results which will eventually give you the highest growth of net profit in the end. Okay. Brent Toyer is another one. We can keep going like this. We can keep asking the same questions, isn't it? Is this a good buy, the entry, the trade management, and the exit? A very popular one at the moment is gold, isn't it? So in fact, we look at silver as well. So let me just take a look at silver. Silver over here. So what do you all think about silver? Is this a good buy at the moment? Not only is an entry, remember, trade management and also exit point as well. We actually ourselves bought Bitcoin at 10,000. Okay. Currently it's at 37. We bought silver as well. We bought silver at $26. Okay. Which is still around there after 6 months. Okay. But we'll still hold on to it. Okay. And I'll give you some basic principles of why you must hold on to stuff and why you must sell it to give you the edge. So let's move further that I've given you these 3 questions that you must be looking at. So let me just bring up the presentation once more. So we'll keep doing that. Thanks for the interaction. And that's how we all learn. Now, what we just did over there, let me just share back the screen again. Okay, I can see some questions coming in. I'll take the questions later on. Let me see. Okay, good. So I can share. That's great. Technical. Right. So what we just did just now, so let me just do this. So what we just did just now, we looked at the 3 questions. Okay, we looked at some examples on the charts. We'll go and look at more share and stocks examples later on as well. Now, hopefully that has been understood. Look at all the 3 questions. Okay, but you see, just did it was some kind of basic technical analysis. I always tell all traders and investors, whether you use technical analysis for your full-on trade management, entry and exit is immaterial. But what I always would suggest is that some kind of basic technical analysis is necessary. And if you combine with fundamentals, then of course, anything in combination is always more powerful. It's a principle. Okay, right. And you can use the technical analysis, basic technical analysis for trading as well as for investments, which we will show you in a minute how you can do that. Basic technical analysis, we actually did this as a movie actually, and we actually filmed this in Empire Cinema. It's there for free as well. You guys can watch it. It's a 5-part video series, Trader Starter Pack, and it's all 15 minutes. End of day trading is what we teach. Basic technical analysis. I would highly recommend that everyone understands this basic technical analysis of trading, which you can use for trading or for investments as well. Okay, I'll drop in the link later on. Now, you see, in technical analysis, traders and investors alike, there's 4 market principles, and these are very important. I'll share this with you guys. The first point is most of you will agree that price never moves in a straight line. Therefore, it moves in cycles. Okay, if it moves in cycles like this, then turning points are created in the market. Okay, turning points are created in the market. The turning points can either be a top or a bottom, a top or a bottom. Okay, now turning points are created, the tops and bottoms. Inevitably, a swing distance is formed between them. We call that distance or swing distance technically. Okay, inevitably swing distance is formed between them, which is what we call either a bottom to top move or a top to bottom move, a bottom to top move or a top to bottom move. Okay, exists in the market at all times. You see, bottom to top or top to bottom. So this is called top to bottom and this is called bottom to top. But one of the most important things, which this will lead to point number 4, and I'll tell you the one other point that I need to move in a linear fashion, therefore it moves in cycles. Point number 2, bottoms and tops are formed because it moves in cycles. And because of point number 2, a distance is formed between them, and therefore all market moves can be compressed into 2 types of moves, bottom to top or top to bottom. And finally, the bottom to top or top to bottom creates a swing distance between them that helps us understand the average swing distance between a move. Okay, so let me ask you, this is very, very important for either trading or for investment. In fact, 99% of traders do not know this. Let me explain. So you see, first of all, before we can say something is a bottom or a top, we must quantify what a bottom is it not? So you see, for example, if I say for something to become a bottom, the first thing is that it must be the lowest point of a move. Okay, the lowest point of a move. And before I can say something is a bottom, a top must have been confirmed. Okay, two very basic principles for quantifying any bottom or top. Then the next thing is that the next thing you got to then ask yourself is at which point will you say that this is a bottom? So, for example, if we say a very simple formula, we say whenever something has moved by 100 points, or let's say just by $1, right? Or let's say in the currency world, we say 100 pips. Whenever something has moved by 100 points or 100 pips, we can say that is a bottom. Okay. And let's say that is the bar that confirms the bottom. Right. Now, however, however, if this is one way of quantifying a bottom, another person might say, you know what, Thiru, I don't really agree with that. I would say that I would consider something as a bottom only when, let's say, I want to put time as well into it, only when 2 days have passed or 3 days have passed, and also it has covered a distance as well, time and distance we use for quantifying a bottom. Okay. Now, once you have quantified the bottom in whichever way, then a good quantification traders and investors, a good quantification of a bottom or a top will ensure that every time you get a signal to buy, there must be move left in the market. If your quantification is poor, then it will keep turning at the point where you buy, isn't it? So this terminology that we say, how much move is left after you buy, after, according to your quantification that a bottom has been formed, smart money has come into the market, how much move is left in the market is what we call open equity. Okay, you must always know that. So you see, for example, if we go back to the example of an investment, you see Bitcoin, some people are asking, oh, is it good to buy Bitcoin right now? Oh, is it good to buy gold right now at $1,800? The most important question you must ask yourself is not the entry price alone. Everybody just talks entry. You got to ask yourself, if I were to buy at this price or buy at 40,000, how much move is left? How much move is left? Is there only 10,000? Is there only $1,000 left? If there's $1,000 left, what's the point? If there's $100,000 left, then there's something there. Everything will make sense, right? Your reward, your risk ratio, everything will start to make sense. Always ask yourself this question: how much open equity is left? Okay, so that's what we keep asking professionally. How much open equity is left? Now, a good quantification. Now, how do you say that one way of quantifying a bottom or one way of quantifying a top is better than the other? Is based on this: the quantification that can give you the largest average swing distance, the average swing distance is the best kind of quantification. The largest average swing distance, the quantification that can give you the largest average swing distance is the best kind of quantification, because there will be there will be a good open equity left. There'll be a good open equity left. Okay, right. So let's apply all of these four market principles in trading as well as in investment. So to build an edge in trading, especially, it's a statistical probability game. So for example, this cash in 4.0 strategy that we do is it's really 15 minutes end of day trading. So let me just stop my share. Let me just bring up the charts. Okay, so let me just do that very quickly. Right, so over here you got, let me see. Right. So let me just bring up this, share the screen. Okay. Right. So you can see over here, this is just a dollar yen example, very simple example what we got. You see, wherever we get the dot, can you all see the dot over here? The dot. The dot is according to our algos is when a top is confirmed. So in trading, whenever we get that kind of a confirmation, then what we usually do, because we are confident in the quantification of it that has been taught to us by institutional traders, we know that there is open equity left. Look, after the dot, if the quantification is poor, as I said, it will turn around immediately, right? But if there is move left, that means there is open equity left, then what will happen is it will carry on. As you can see, after the dot, it carries on at least for a few more distance. It carries on for a few more distance. It carries on for a few more distance, right? And then eventually, if you were to just do that simply, I mean, in this example, 431 pips, 10 pounds a point is 4,310 pounds. But, do this for your own self. Don't just take my word for it. The quantification is what is critical. So for example, Brent oil again, you see, look, the dot, there's move left, dot, there's move left. After the dot, there's move left, right? So these are the things that we should be looking at. Open equity, is there move left in this market? Is what we got to continuously ask ourselves. Okay, let's take a look at another one over here. Do I have dollar Swiss over here as well? This is on the MS tree, market structure tree over here. Yeah, again, you can see from the dot, there's move left. From the dot, there's move left. From the dot, there is move left. Open equity, you got to ask yourself, is there move left after your signal of quantification comes back in or not? The Dow Jones, again, ask yourself again, 31,000 at the point, how much move is left in this market? Okay, you see, for example, let me just show you this. In last year in February, the Dow Jones did a drop of 18,000 points. Okay. At this point, just based on the three questions which I've taught you so far, which is entry, trade management, and exit, whether it's a good buy to do or not, we should already start to think and how much move is left in the market. What people cannot really guess is how long it will take to get them. Okay. Right. I'm just aware of time, so let's move on swiftly from that. So the main point to take from there is how much open equity is left is what we have to ask ourselves at any trade or investment that we are taking forward. Okay, right. So let's see. So that's the cash in 4.0 strategy, which I just showed, just basically taking on the quantification. Again, that's explained the trader starter pack. Now in investments, the most important thing always, as I said, ask yourself whenever you buy any investment, the main thing for building an edge in investments is there fundamental value in the investment for sustainable growth. Why will that investment keep growing? And the next thing you got to ask yourself is how much open equity is left. You see, unfortunately, even before we bought Bitcoin, I know you dropped to 3,000, 7,000. We kind of knew, we done our research, we kind of knew that Bitcoin was a good investment, but we couldn't answer this question of why must it sustain? Why must it be here 20 years down the line? What is the demand for it? What is the fundamental intrinsic value for it? And traders, investors, doctors, over here listening, I'll tell you one thing, there's very few people who can answer that question whenever I ask that. They just follow the media or follow whatever their friend says or whatever the newspaper says. But you have to do your own research. Why must Bitcoin sustain? Why must gold be there for the future? Why can't it drop to zero? Why will silver always be there? The fundamental value, why must it be there? Why must it keep on growing? This is the basis of all kinds of investments that Warren Buffett does as well, intrinsic value. What is the fundamental value? Why is Bitcoin increasing at such a rate? Why must it things must be questioned. These things must be read. And until you can convince yourself, then do not get into the investment. And then finally, you got to then ask yourself, how much open equity is left? How much open equity is left? Okay, good. The same thing for here, Bitcoin, gold, and silver. In fact, we have written articles as well. So if you actually go on to here, so let me just stop the share. I'll show you some things that you guys can read into based on that question. Okay, based on that question. Let me see over here. Um, let me just bring that up as you guys are waiting. Good. Right, let me share the screen. Okay, good. So here we are. So that's our website there, masterthemarkets.net. If you go onto our blog, there's a lot of every week we update stuff. But what I want to bring your attention to is two articles. One, there is this thing of gold. We wrote a three-part series on gold, okay, on why its value must sustain. So read that. That is very important. It will also help you understand the whole monetary system as well, okay, for your understanding. Three-part series for gold. Okay, is there move left, open equity, and everything is written there. Also, another one that I highly recommend everyone to read on understanding money and mastering it. Understanding money and mastering it. Okay, so let me show you. There you go. This is the article there. There's some very, very important links inside there that I would highly encourage everyone to go and look into. One is Hidden Secrets of Money by Mike Maloney. The Big Drop, there's a free book link we have given. It will instantly download into your PC. And then finally, Money Master the Game book as well by Tony Robbins as well. Highly recommend you all to read this. Will give you a very good understanding of the monetary system, where to invest your money, and also all the tips and principles that I'm giving.
We lost your voice, Thiru.
Right, I think that was I think I got muted for some reason. I don't know why. But as I was mentioning over here, just very quickly over here, this is the article that I would tell you all to highly encourage you all to look at, Understanding Money and Mastering It. There's 3 links over there. Hidden Secrets of Money by Mike Maloney, Big Drop by Jim Ricketts, and Money Master the Game by Tony Robbins. All these are all free to download. Highly recommend you all to read it. You will get a very good understanding of the money principles and also why certain investments will have intrinsic sustainable value for return. Will give you the conviction for any kind of investment or any kind of trading that you will be doing. And also, I was also mentioning that, on our blog over here, you can find this all on our blog as well. So let me just go back a little bit here. So here, I was just also mentioning that I don't know if I was muted by then or not, but also the gold 3-part series articles that you guys can read as well. Okay, the gold 3-part series articles that you all can read as well, which is over here. Okay, right, good. So that's to do with that. Let me just go back to the presentation. Okay, so that's that. Finally, I want to import you this as well. Okay, just got about 7 minutes left. Now, this is very important. We talked about trading, we talked about investments, we talked about different investment classes, which I just introduced in the beginning of stocks, mutual bonds, mutual funds, bonds, real estate, and all of that. But how do you allocate your assets? What percentage do you put into each? So in the book Money Master the Game, Tony Robbins went to interview the top traders and investors all around the world. All right. Very interesting book. Highly recommend everyone to read it. Inside there was Ray Dalio. Now, Ray Dalio is the biggest hedge fund manager in the entire world. I think some of you would have already heard of him. Ray Dalio is basically the owner of Bridgewater Associates. They've got $160 billion in assets under management. And in that, basically, Robbins then tells Ray Dalio tells Robbins, finally, Robbins convinces Ray Dalio to give this formula for the layman out there of how they can allocate their assets. So he runs some tests and everything. Then finally, he gets this simple formula model that we can use and which has been tested to prove itself over the last 50, 70 years, even through all the biggest worst of crashes and the depressions. So here is the image that is also in the understanding in the gold three-part series articles that we have. You can see over here, it's not that clear, but as you can download it, you will see as well. So you see in gold, he recommends 7.5%. Commodities, another 7.5%, like Brent oil, soya bean, wheat, and all that. Stocks, 30%. Intermediate US bonds, 15%. And the long-term US bonds being the most part where your money will be 40%. Of course, we can adapt it to the UK environment as well. But his biggest asset allocation is towards the bond area, which is more safe and secure, and the others are a bit more volatile. This is what he recommended for the general retail investor. Okay. That is an important one that you guys can read. I've given the link anyway, right, in the Understanding Money and Mastering the Game article. So you can download the book over there. Okay. Right. Now you have in the three-part model framework, I've given you a lot of knowledge, application, and how you're going to apply, that's up to you. But you see, sometimes even though people gain all this knowledge, especially as doctors and researchers, I was in the research field, I'm still in the research field in terms of the financial markets. But even then, after getting all this knowledge, sometimes we ask ourselves, hey, why am I not acting? Why are all these opportunities, going away in front of me, right? Some of you would have known, some of you thought to yourself that you should have bought Bitcoin. But some of you haven't bought Bitcoin yet. Some of you are still thinking, should I buy or should I not buy? Should I buy gold? Should I buy silver? Should I buy Apple? Should I buy Tesla? You ask all these questions, but you're not sure. And sometimes opportunities just go by. What is then the biggest challenge that people face, especially doctors? We got a lot of clients who come to our trading workshops, investment workshops as well. What is their biggest challenge? The biggest challenge is usually two things that everyone has around the world is time or money, which is what we call the time and money link, right? Where you exchange your time for money and therefore you get short of time to do things and expand your knowledge on investments and trading to come out of this time and money link so that you do not need to work for money. Do not need to exchange time for money. You can work as a choice, not because you have to or must to. So you see, this is what we call the time and money link, right? It's a global problem. High earners, they do not have enough time, and they cannot choose where they want to put their time to. And mid earners, they're caught by both. Not enough money, not enough time. Doctors usually will be more in the first part where they do not have enough time. They're earning quite a lot, a good, comfortable money, but they don't have enough time. In fact, one of my surgeon friends always tells me this thing. He says, Thiru, even though surgeons, they do get paid quite a bit and everything, but actually, when you divide the salary amount that they get by the number of hours that they actually work, the hourly rate probably would be less than even a McDonald's worker. So these things, makes you think, how can we really free ourselves? The freedom of time is the biggest important commodity. In fact, in like what Warren Buffett said, he said, if you do not find a way to work, to make money work for you while you're sleeping, if you do not learn a way to make money work for you while you're sleeping, you will work till you die, right? And no one wants that. In fact, we had a very recently a doctor who joined us on our Traders Basecamp package as well. And he told us, actually that Thiru, he's a doctor, he's a specialist and all that. But he said just recently, he had health issues, he had back issues, he couldn't go to work anymore, and he had a daughter that he had to look after as well. And he said he just had to look at different options and choices. See, that's another thing we have to remember as well. Um, a lot of things in life we take for granted. We also have to go to prepare for scenarios when we might not be in the best of health and we have to have other options as a backup. Okay, so that's why any kind of time or knowledge invested into investment asset classes or trading is well worth it. Okay, so what is the solution to this biggest challenge of not having enough time? Everybody says that, right? In fact, I spoke to Dr. Vivek and Anup as well before we started on this, is that they always told me, oh, but doctors don't have enough time, they do not have enough time, which I agree. Okay, so there are different ways to overcome it. First of all, the first thing is, what do you all think would be? Just type into the chat box. What do you think would be the solution to overcome your biggest challenge of time? What do you all think would be the solution to overcome your biggest challenge of time? The first thing I would say, as I said, in the three-part model framework, knowledge, right? Expand your knowledge. You can't say that, you won't even have 30 minutes in a week. I'm not even saying anything big. I'm not saying 2 hours a day or anything. No, I'm saying even do 30 minutes a week, or even if you cannot do 30 minutes a week, maybe 30 minutes a month. It doesn't matter. Choose the thing that you are comfortable with. But to get that 30 minutes a week or 30 minutes a month, the first thing you need to do is what? Prioritize. Prioritize. Prioritize what's important. Now, to get it even more specific, in fact, Brian Tracy, one of the biggest business management education provider over there, he mentioned one of the questions you can ask to your mind to keep it so laser focused is, one question you can ask yourself is, if there is one thing, if there's one thing I want to achieve this year, okay, apart from my normal profession and all that, if there's one thing that I want to achieve for this year, what would it be? Just one thing. Just ask the mind, what is that one thing that I want to achieve for this year? We usually ask that to all our traders and investors whenever they join us. If there's one thing that you want to achieve for this year, what would it be? Then extend the question a bit. If there's one more thing, what would that be? And then finally, if there's one last thing that I would like to achieve for this year, what would that be? Three things. Keep three goals. And then you keep reflecting on it. How much am I expanding on those goals? And you keep prioritizing. But education is the first thing of the three-part model framework. The second thing that you can also do is to overcome this challenge of no time or not enough money, whatever it may be. The best way to overcome, even though you may know all the knowledge, but to get to action, is hang around like-minded people and read the books that they write as well. So this kind of environment that Dr. Vivek has created is very very good. I highly recommend that you keep up the momentum and keep coming for the sessions that he is doing, because with this education and this knowledge that you're learning, you will overcome your habitual patterns of not putting your time in the right areas and becoming more disciplined and becoming more structured and taking more action towards where you want to get to. Okay. The last thing is, after you know all of this, is maintaining the consistency. Okay, consistency. But the main thing that will help you towards all of this is, I always say, is number two, hanging around like-minded people and read. So prioritize people and books and consistency. And I'll leave you with this one quote: ordinary things done consistently produces extraordinary results. So that's why I'm telling you, it doesn't matter. Even if you do 15 minutes a month, 15 minutes a week, it doesn't matter. Just do it consistently. And that will then take its shape and form as we go forward. Okay, so finally, just to recap the three-part model framework for sustainable success: knowledge, application, and finally the psychology, which is a little bit which I just covered in the last part. Okay, right. So we got this small exercise. We usually will give a gift, usually just 1 minute thing. So whoever answers the question first or gets the right answer, we'll give that. In fact, the prize for this is that we'll give you the Money Master the Game book. The book by Tony Robbins, where he's interviewed all the top millionaires and millionaire traders and investors all around the world, which I referenced to just now as well. We will send that to you free of charge. We'll pay for all the shipping and we'll send that to you if you can answer these three questions. One is, what are the two main areas for knowledge in the three-part model framework? I've covered all of this in the presentation, so whoever's listened to very well and paid attention, if you can just type in the answers. If you can get all the answers right to these questions, you will win the prize of Money Master the Game book. So in the three-part model framework of knowledge, what are the two main areas that you must have knowledge in? Where is the biggest allocation recommended by Ray Dalio? And if there's one thing you will do to overcome your biggest challenge of time, what would it be? Okay. So again, I will look into it very shortly. And I'm just coming to the end part. I'm concluding already. Some reference points for you guys to look at. Uh, after this presentation. One is our trader starter pack on trading, basics of technical analysis. The other thing on asset allocation, you should be looking at understanding money, the blog article, which I given all the links in our Master the Markets blog page, the Gold three-part series article on our blog page as well, and also Principles by Ray Dalio. There's a nice book written by him as well. It's very good. I highly recommend it. And then finally, for psychology, highly recommend Personal Power by Anthony Robbins, and also all Bob Proctor videos. They are very, very good, very, very powerful, only for you to sustain your momentum to continue and grow in this area, okay, of money master the game. Right. Um, our Traders Basecamp package is something that you can look into. It includes property and stocks as well. And what I would also highly encourage everyone who's got any questions. I know sometimes I might not be able to answer everything. Some of you might be having any individual questions that you want answered, that you want to talk to us about. You can always book a coaching session with us. I'll put the link into the chat box very shortly. So you can definitely do that. And we can go through more things in detail. I'll also answer all the questions in the chat box also that has been there. And then finally, our trader starter pack, 15 minutes end of day trading. I'll also put the link in there as well into the chat box that you guys can look into. Okay, good. So that's it. I think I've here just so far what we have shown you for today, and you should know by now the three-part model framework for profitable returns, the asset allocation portfolio by the biggest hedge fund manager, which I've shared with you. And also finally, you should also know how to overcome your biggest challenge for continual success. Okay, great. I think that's pretty much that from me, Dr. Vivek. Sorry, I've just gone a bit over time by about 7 minutes, I believe, actually. Yeah.
Thank you, Thiru. That was absolutely phenomenal. Absolutely no
I can't
problem.
hear you, doctor. I don't know why. Is it me or
Uh, can you hear me?
not sure why?
Yeah, we can hear you,
Can
Vivek.
you? Yeah.
Okay,
I think
thank you.
fine.
Thiru, that was lovely. I don't know whether you can still hear me or not. Others
Can
can
everyone
look
else hear?
like. So wonderful and amazing presentation, very crisp. And I'm glad you have given us a lot of good knowledge. So at the moment, I think it's a time for break. People must be getting a bit itchy sitting for a while. So what I'm going to do is launch a poll which people can fill during the break time after taking a comfort break. And so the time now is 13:08. We will recommence
I
at
can't hear you. Let me just see. Hang on a minute.
13:15. Till that break time, I'll put some music on, and then after some announcements which are important, over 5 minutes, Thiru will be happy to answer all the queries.
Hmm.
And I'm launching a poll. Please feel free to answer over next 10 minutes, please. Thank you. Zooming. Over to you, Thiru.
Can you hear me okay? Can you hear me okay or not really?
No, you're very low in volume.
You're very low in volume. Okay. I'm not sure why the thing is. Better now?
Yes, we can hear now.
Yeah, it's much better now. Okay, good. All right. Not sure the headset is playing a bit funny, but any case, so let me just go through some of the questions here, and then as they come along, I think you can put in more questions if you guys have any questions or not. So the first question that I had was, how can you know open equity if neither top or bottom are fixed? Okay, I think that was done by Ramesh, isn't it? Is that right? Let me just get that very quickly over here, just in front of me, so that then I can um, yes, that's right. So Ramnesham had asked this, how can you know open equity if neither the top nor the bottom are fixed? All you have is what was the top or bottom in the past. Okay, so this is a very, very good question. So you see over here, if let's take a look at over here. So I'll show you both, and I'll show you open equity results. You see, this is just one way of quantifying a top or bottom. We can't say that, it is the best way or the worst way. We can't say all of that. It's just a model. And remember what I said, a good model of quantifying a top or a bottom should have move after that. If it doesn't have move, that means once the confirmation comes, according to your formulas, that that's a bottom, it must carry on after that. If it doesn't, and if it does turn immediately, then that's not a good quantification. Okay, so you see, for example, now you got all these tops here, right? Which we have programmed with the help of the quant traders. But you see, for example, if I remove that, you see, you don't have any more bottoms over here. How can I measure? How can I get consistency? How can I get my statistical probability? I can't do any of that in trading.
Sorry, Thiru,
And you
we
can
can't
also
see your
use this for
screen.
investment, even though your
Thiru,
fundamentals may prove right, but you can just use that as an entry point. Okay, when the bottoms
Thiru, we
come through.
cannot see your
Now,
screen.
if I were to then put this, let's see now.
Thiru, can you hear me?
Maybe I'm not sharing the screen. Okay, let me just share the screen once more. So you see, what I was just mentioning is that if you do not have the arrows, right, the tops or the bottoms over here, if you do not have that, then you do not have any kind of quantification or any kind of statistical probability for how much the move can go after you get the confirmation. Remember what I mentioned before is that if it's a good quantification, if the confirmation bar comes and the bottom comes saying that that's a bottom according to your formulas, there will be move left after the dot comes. If it's not, then it will immediately turn. Okay, some kind of quantification is required, especially when you want to run the statistical probability game. Also, you won't have any model to prove any consistency. And you can use this principle even for investment, just to time your entry, but using the strength of fundamental value behind there as well. So let's take a look, right? Now, if I were to put the thing in, so let's see now. If I were to put this in here, let me just put the indicator back on again. Um, right. Oops. Okay. Let me just putting the indicator back on again. Just bear with me. Right. Okay. Good. So I've done that. Let me just share the screen once more. Okay. Good. So we got this now. So you can see over here that if I were to, you see, you can see the arrows coming back up again, right? Now, once you have that, as I said, there's some move left. Now, the question is, how do I know if for the future it will run? If the data has said that over the last 10, 20 years it works, it's okay. I mean, still doesn't mean it's going to work still going on further. But the only way is when you put it in forward testing time. Remember one thing, if your quantification is good, and if the currency is liquid, or if the instrument is liquid, whatever stock or currency or commodity or index it may be, it has got to move. So depending on if your quantification is good, as I mentioned again, it will have to move if your quantification is good and the instrument is liquid. So we keep doing our statistical probabilities on this. So for example, you can see over here, we've got tables here. You see our open equity tables over here on the how much open equity is left. You see over here, open equity, once I get the confirmation dot, right? What is the probability of it moving another 25 points? 87%. What's the probability of it moving another 50 points? 73%. What's the probability of it moving another 75 points? 67%. What's the probability of it moving another 100 points? 60.14%. Remember, especially in trading, because it's a large frequency of numbers, we need the statistical probability for it to win and move forward. For investment purposes, We can also use the statistical probability, but on the fundamental question of is there fundamental value and what is the research says about in terms of what is the highest they can go to and what's the sustainability for its growth. So still, and where you enter and how you enter based on trend, simple basic technical analysis is still required even for investment purposes. Okay, so that was the first question. Hopefully that answers your question. And even Ramnesh, even if you were to look, let me just take a look at even stocks over here, right? So I got Google over here. I got the arrows here as well. So you see, we would have got a signal over here. Even after that, you see there's still open equity coming, right? Even if you look, take a look at Amazon here, this is all current, it just was recently. And you can watch this in real time because, in live trading room that we actually give all the signals live, it still keeps going forward. It doesn't turn around immediately. As you can see over here, Amazon as well. You can see also in Apple as well. As I said, the most important thing is is the instrument liquid as well as the quantification good? It must move a little bit after your signal comes in. If it doesn't, and your open equity data is not good, then the overall net profit will be poor as well. Okay. All right. You can see over here, there's a confirmation here. There's move still left after that. All right. Depends on trading and depends on your time factor on how you want to hold as well. Then the exit points will start to change. That's why even in our trading and investment, we always do two types of strategies. One, we call it a 20% open equity, which is basically 20% of them will reach that. It means a very large move you're looking to get. Only 20% of them will get there. That means the reliability will be much lesser. It means less of them will win. Whereas the other one, 70% open equity, which is very short runs, but most of them will get there. 70% of them will get there. So then we balance the portfolio as such. Okay, by the big runs and by the short runs and reducing our time. That's how we do that. Okay, hopefully that answers the question. Now, predicting outcome. At the end, these are all predictions. Yes, you're right. These are all predictions. This is why you must know your probabilities. Okay, this was why you must know your probabilities. This is what we all have over here. We have different market structures also, so we do a lot of research. That's why most of our strategies and systems are all research backed. The last one of the other questions which I had, some other questions were repeated, so I guess I've covered some of them already. And the other one that I had was algorithm platforms, how different are ours? Remember that over here at Master of Markets, what we're doing is, yes, only a part of it is the tops and bottoms are covered by algorithm, but it's not totally automated like a robot kind of a system. You see, what we have here is a bit of in between. What we have is the help of algos plus principles. Very important because you see, the specifics can change, but the principles will stand through time. So over here, not only do we show you strategies that we do, but also teach you how to build your own strategies as well through principles. And that strategies can be applied to either trading or to investment as well. And we've partnered with other like-minded educational providers who also talk about how to use these principles in specific areas of the niche of their fields in real estate as well as in stocks and bonds and whatsoever not. So it's not totally algorithmic. But if you talk to us in terms of pure trading wise, then our main unique focus is option traders. Then we all our systems are research back, as you can see all the stats and everything, and we got research collated documents and everything. And also the last one is transparent results that we do. Okay, we are fully transparent. So for example, let me just show you this in the live trading room that we do. This is the thing that we are known for. We fully transparent in everything that we do because we show you all the profits and the losses. Okay. Let me just show you this very quickly. Right. We have a journal over there, so it tells you exactly what date we enter, whether to enter or not, how to do our trade management. Everything is there. where the target is going to be set to. Everything is shared on this journal in real time on a Dropbox folder. Tells you what time you're exiting. So, to answer all these questions of, oh yeah, it's historical, well, why will it sustain everything? It's all locked in here. It's all in real time. So you see, for example, there's a trade that we took recently on Cash in 4.0 TSL primary. You see this dollar yen, 27th of Jan, we took it. Right now, we have trailed the stop loss. You can see this is carrying on. All the ones in green are all carrying on. And 1st of Feb as well, we took this as well. So you see, for example, if you go back to the charts and then you take a look at this, you can see over here, dollar Swiss, right? So dollar Swiss, let me just, yep, this was the place where we entered. It will correlate on the journal. It's in real time that we capture all this trade. So take a look over here. So where we entered, you see, 1st of February 2021. And if you look at that, it will correlate, right? So 29th of Jan, this was a Sunday, and that's when we entered on the 1st of Feb on the close, and the next day was the 1st of Feb. And we're riding this move at the moment. Okay. And then dollar yen was another one as well that we did as well. That's also on the journal. So this is all in real time, right? You see? So you can see that the quantification still works in real time as well. It's repeating itself. Okay, it's not because these are used by institutional fund traders. In fact, that's how we got it. In fact, the mentor that taught us, he trades money for Morgan Stanley. All right, he owns his own hedge fund. Right, you see, this is another one that we entered as well. You can go back to the journal. Okay, we run a live trading room every day in the evening. You see, this one was 27th of Jan where we entered that trade. And you can see over here as well, 27th of Jan, we are running it. So, but there's two different versions of the strategy. One, we exit within one day. Another one, we let it run. This strategy, only 20% of them only will make 80% of the profit. So it needs a lot of patience. At the moment, this two alone has got an unrealized profit about 7 to 9%. Unrealized. We haven't closed it yet. Okay. So that's how this whole thing is balanced. But everything we are fully transparent. You can see all the losses, all the wins, see all everything we are transparent. See three losses we have taken here, minus 2%, but then it will cover up by the big winners that is made up by 20% of them. And like that, we build different strategies based on these principles, like a one-day exit, lift off, primary runners, all looking at different parts of the market for sustainability and scalability and reproducibility. But these principles, as I explained, it's not like a robot kind of a strategy. The principles are there which can be applied to trading or to investment or to build whatever strategies that you want to. Right. Questions. Okay, some other things came in as well. High leverage is needed if you're aiming for small number of, which means high risk. Okay, Vinod is asking. So that is very thoroughly covered in all our videos and materials on how to manage your risk. Whether it's foreign exchange, whether it's commodities, coffee also we trade silver as well, or any other investments like you want to do in Bitcoin, silver, whatever. The risk management is there. We know how to do the risk management. The maximum you can ever lose. If you want to do percentage risk management, it's just 1%. And as you get confident, you can then do 2% or 3% or whatsoever not as well. But you have to know how to calculate it. All that is also taught to you in the Trader Starter Pack, the link that I put over there. You can watch the videos. It will teach you how to do that. How do you generate those percentage tables? As I explained to Amit, it's based on a couple of factors. One is the quantification of the bottom and the top. Okay, so if I were to share my screen again, so you see, so this is the thing that we are known for. This is very important, as I said, for trading or investment. How much open equity is left after you got a signal? How much open equity is left based on different instruments? You must know your open equity tables, but it's a step-by-step process. You cannot know your open equity tables, you cannot have conviction in it if you do not have your bottoms quantified. Okay. If the bottom is not quantified, then you cannot go to the next step. So the first step always is to quantify your tops and bottoms. 99% of traders won't know how to do this. Even we didn't know how to do that for 2 years when we first started. But so because of the people that we came in contact with, that's how we now know. Now we are in the industry for 10 years and going. Because of this is what gives us a conviction. First thing, you must quantify the top and bottom. Then only you can then create your open equity tables, and then you can see. Then the third thing is then forward test it, see if they sustain in real time. Okay, but you will know. Data won't lie. If something has been repeating for 20, 30 years, it will repeat if the instrument has got liquidity and if the quantification is good. Okay, and that's how you build conviction as you go forward with. So based on this is then how we build this table, this open equity table. You see, more than 25, more than 50, more than 75, all that. We keep looking at it. We keep looking at different things as well. See, look, this is a different part of trade setup that we are looking at as well. All right. All this you must have. Most people do not have this. That's where they have the issue of sustainability and consistency. All right. Um, Hopefully that explains, Amit, for asking those questions. And then some of you asking, how can you consider a top if we do not know? You can always get the smart money indicator from us as well that will quantify and do how 80% of your job for you actually. Okay, but I will highly recommend, at least to get the basics, I would just say, watch Trader Starter Pack, the link that I shared at the top over there. And another one which I shared is if you want to ask any of these one-to-one questions, you can always book a coaching session with us. Okay, I'll just reshare that link again over here. I think that's pretty much whatever questions that we have and time for. I guess that's pretty much that, Dr. Vivek.
Thanks a lot, Thiru. That was wonderful, and I hope everybody have their questions answered. But if there are any left, please feel free. We can stick for 5-10 minutes more. Any more?
Vivek, I just wanted to ask Thiru, what does he think of index funds?
Yeah, just to
Your voice is going, Thiru.
okay now. Okay,
Yeah.
great. Index funds, yes, I would highly recommend them. But you see, with everything, there's pros and cons, right? I mean, anything in life. Okay, so a couple of things. Now, if you want totally your mind off this thing, and you want growth for the long run, and you don't want to look at the charts at all, index funds are very good. Okay, but one important thing you must always remind yourself: if you're going to do index funds, again, the edge in the index funds or investing in the index, you must clearly know in yourself, why is there fundamental value there for the long run? Why will it keep growing? Why wouldn't you not lose money, or why is your risk so less? If I were to extrapolate on that, I'll give you a few points that you must reflect on. Why is index fund the safest kind of investment? Because one, economies and the way its system has been structured, it cannot go bust. It's like saying if it goes bust, then the whole economical system of that country is over. There's no more game to play. There's no, or we can say, quote unquote, there's no monopoly game to play. So that's point number one. Because of how the monetary system has been structured, and the whole monetary system is regulated by the Federal Reserve Bank. Every country, if you see, the monetary systems are very similar. It's like, they've cloned it, right? Every country will have a central bank, most countries, okay? And it's all based on the central bank monetary system. So that's point number one. Because of the central bank monetary system, the probabilities of any economy of a country going absolutely zero is very, very low. So if that is very low, then the second thing is that following on from that, how can the index for that country, for US, or the Nifty for the India, Dow Jones or S&P for the US, Nifty for India, the DAX for the Germans, FTSE for the UK, how can it go to zero? Index funds also, if you talk about the Dow Jones 30, is always tracking the top 30 industrial stocks in the US. If any of those businesses are underperforming, they're immediately and automatically taken out and they're replaced by another company. So it's doing that. The index fund is automatically doing that. The index is doing that because it's the average, isn't it? Whether it's the Nifty, whether it's the FTSE, whether it's the Dow Jones, it's always doing that. It's the average of the top 30. Because of that also, it is quite stable because it's always monitoring the top 30 companies. Now you must understand another fundamental point here. Because it's always tracking the top 30 or the 500 S&P 500 or Nifty, whatever it may be, whatever index may be, because you're always tracking the top and replacing the worst ones by the top ones, the top 30 or top 100, whatever it is, because they're doing that, the average and the robustness of it is quite stable. And also, very important point, those are the main ones that are fueling the economy of the country, is it not? Think about it. Those are the 30 big companies of the entire country. They must be contributing a major part to the economy. So you see, for all of them to go bust is very rare. So the probability is so low. That's why index funds, no matter how much they drop, but if you don't take out your money, that means you're not realizing the loss, eventually you will come out of it. Eventually it will keep going up. That's why it keeps going up no matter what. There's always open equity left. Understand? Because of these fundamental values. But the only downside to it, which you must think as a trader or as an investor, is even though the index funds are low risk, okay, very low risk, and because they got to grow because of all these fundamental points I've told you, but the downside to it is you must wait quite a long time, right? Because you see, um, in a recession, it takes 6 months to lose 6 years of gains. It takes 6 years to go up. But in 6 months, it can just drop all those gains. If you just saw even the February chart that we looked at, if I let me just see if I can share my screen. So you see, the Dow Jones, if you take a look, that is only the downside. But if you're okay and patient for the long run, then it's fine. So it depends on what you want. Okay, so you see, for example, when it dropped, look at the drop, right? 18,000 all the way to 18,000. Okay, from 30,000, okay, 12,000 point drop in how long? Look, from February to March, in 1 month time. 1 month time, it dropped everything. If you go on the weekly chart, if I were to shrink that for you, so you see, take a look at this, right? You see, look where this red line is, right? And look where it started to climb in here, from all the way from the bottom here. Look, let's shrink this. See, all the way from the bottom, 15,000, 15,000 all the way, it went up to here to 30,000 over here. Let me just bring this up, down to 30,000 over here, right? And how long did that take? Look, 2020, it started from 2015. Okay, 5 years it took. Look, and just in 1 month it drops, right? That's the thing. Yeah. So, but remember, but if you're playing it for the long run, it's fine because you know that the fundamental value of this, it cannot go to bust. There are multiple reasons why it cannot, very low probability. So you just hold on to it, but it would take a long time. But that's why you should know both. That's why I tell all investors know both. Because if you know how to short the market during these times, you can hit your portfolio, create some really great cash flow, and then put into other asset classes like bonds or real estate as well. Okay, so that's how you should know, and you should know your outcomes based on that. Then you can play the game. But for safety reasons, if you want to be really conventional, very safe, not interested, don't want to learn anything about all this trading or whatsoever, then index funds you can, but you have to play for the long run. Okay, that's all I would say. But know the fundamental value why they must sustain. That's why those three links that I shared, Those three links that I shared in understanding money and mastering it. But the Hidden Secrets of Money by Mike Maloney and all that, you must watch. They're all so much free content. Just watch it, a little every day. Instead of watching Netflix, sometimes you can watch this as well. Okay, right. Okay, good. What about putting money in bonds? I think I've already explained that already. Huh? Um, so you can definitely read that Money Master the Game book by Tony Robbins, where he interviews Ray Dalio, and you can look at also where the bonds, where you can also invest in bonds as well, and also the Big Drop by Jim Ricketts, all in that article, Understanding Money and Mastering It. It's all in there. Okay, it's all in there. Let me just, because the question is coming up again and again, I'll just show you all where you can access that very quickly. So there you go, our blog. Go to here, go to blog under masterthemarkets.net. Okay, masterthemarkets.net. Go under menu, go under blog, and you look for this article. So you can just search under here as well, Understanding Money. So then we can find that very quickly. Maybe I didn't type it correctly. Let me do it again. Let me go on the blog. Right. Or maybe you can just scroll it here. Let's just scroll. There's quite a few over here. So you keep scrolling, find it, and then you can then find it here. So let me very quickly put it across. So I think it's the next page after this. You can look at all the, there you go, this article, yeah? So you can look at that, and everything here, there's all digital links. Here, this one is a YouTube link. It's got a playlist of 10 videos. Watch it. It's highly recommended. You'll understand the monetary system, why some things will always sustain value, like the index funds, gold, silver, and all that. Big Drop by Jim Ricketts, very highly recommended too. It will explain to you the entire monetary system in a very simple way. And the Money Master the Game book as well, where it will tell you the bonds and all that, which Amit is asking. And also Jim Ricketts' book will tell you as well where you can get them and everything. Okay, so very, very good books. Okay, good. Right. Couple, yeah, thanks. Amit is just saying he likes my way of explaining, very patient. I think as teachers, yeah, you obviously coins. I think I've explained about Bitcoins. I think that's pretty much that, Doctor. I think the questions are pretty much similar. I think we've covered most of them.
Yeah, they are being recorded, and if people have missed because of late arrivals, they can have a look at the recording, which will be put on the channel in due course of time. So thank you, everybody. If there is no other burning questions, I would like to say another big thank you to Thiru. And with that, I thank you again, all of you, to joining us this